Thanks to everyone for coming to a presentation about accounting on a sunny day. It's kind of strange, but I'm glad. To introduce myself briefly, my name is ADCV. I'm a chef at Steakhouse Financial. We're a crypto-native CFO as a service for DAOs, and we specialize in decentralized protocols. We're contributors to protocols such as Maker, ENS, and Lido Finance. And you can find more information about us on our Twitter, on our website. And what I'm going to, there's a disclaimer for, take the time to read it maybe. But the topic of this presentation is basically triple entry accounting and how crypto facilitates a new type of recording financial transactions that we believe is honestly just better and will hopefully show the way on how how crypto can prove that it can bring utility to the regular financial services industry and make the world a better place. So, to briefly recap, along the stages of accounting evolution, the earliest forms of accounting were probably in Mesopotamia, down on cuneiform tablets in this way, where people counted oxen or goats or whatever on a sort of one-by-one basis, which was the beginning of the sort of science and art of accounting. But the problem with this is that it's very difficult to track mistakes. So if one day you say that you have 5 oxen and you give 12 to a neighbor, you can't have -7 oxen. Luca Pacioli, on the right-hand side of the screen in the 1400s, invented this concept of double entry accounting, where every change in a business goes in 2 different places. So you have assets and liabilities and equity that have to balance. And the advantage of counting things in this way is that it's much, much easier to track changes and mistakes. So for example, if you see an increase in your cash, you know that it had to have come either from your equity or from your liabilities. But since the 1400s, we have not seen many other innovations other than some super creative accounting structures such as Enron in the early 2000s. And by the way, Enron is often cited as a failure of accounting standards or a failure of not enough regulation. But I think that it's neither. So in this specific instance, let's not forget, Enron was a publicly traded company regulated by the SEC, and it filed every 10Q, every 8K, every report on Edgar that it was obligated to legally. And then furthermore, the accounting standards that were in place at the time were perfectly sufficient to have forced Enron to disclose the off-balance sheet transactions that it was making fraudulently. In other words, Enron was violating accounting standards. They existed, and they just chose to ignore them. And so I think that with crypto, we have an opportunity to do things one turn better, and to just be wary of when people say, we need more regulation or we need more rules or more standards. It's not always the case, and it's not always the case that their absence creates these failures. And by the way, in the sort of aftermath of Enron, in the ambition of the government to show that they were doing something, the US government and the US Congress passed the Sarbanes-Oxley Act, which basically increased the amount of paperwork that public companies had to file. And so they thought that this would basically stop future accounting scandals such as Enron, when in fact all it did was push public companies to stay private and not have to bother with all of the paperwork. And so what is triple entry accounting? In 2005, a financial cryptographer called Ian Griggs, predating Bitcoin, proposed a system of triple entry where a third account is essentially an independently verifiable ledger, or a transaction hash as we would know it today. So the advantage of this system is that now when you record a revenue, for example on the Alice side, that same transaction is recorded both on Bob and in an independently signed cryptographically verifiable transaction hash. And I think that this is a very subtle but very important shift towards something that is materially better, because it not only allows you to reconcile and track changes and audit changes in one company, but it allows you to do it across different companies, which is a nightmare in the real world. And more importantly, for things like financially systemically important banks or institutions, it would allow the public a way to basically open Etherscan and check the stability of a bank. the work that we're doing at Steakhouse with the DAOs that we contribute to is to try and instigate this vision of a self-regulated financial industry that allows any and all participants to take place across neutral layers and exchange value with each other. Initially, governments and central banks are going to have a problem with this, or they have a problem with this, because, in my view, I think they struggle at being basically on the same level as everybody else. They're used to operating economies and rules and regulations from a position of authority. But what Ethereum and what decentralized value protocols do is force everybody to sit on the same, to sort of use the same phone line. But I think that this is fundamentally if we can sort of get past this stage of, then they fight you, we'll get to a position where the decentralized layer loses importance almost, and we can really focus on just the value exchange itself. Like if Ethereum and DAI and staked ETH and so forth are all truly neutral, they'll allow any participant, whether they're Anon, whether they're a KYC ring fence, whether they're governments. And crucially, this will, for example, blow up the protectionist banking networks that exist in geographic areas. So today we have sort of SWIFT, we have SEPA, we have CIPS in China and in Asia, we have Fedwire in the US. All of these are a type of tariff on financial transactions. And they make it hard for example, a bank in Thailand to transact with a bank in Chile, because they'd have to cross-check things a million different ways. Whereas on Ethereum or using DAI, they could just transact. To move to the work that we're doing at Steakhouse, so this insane diagram is, for people who might recognize it, this is the MakerDAO contract diagram. It includes a central accounting ledger in the middle called the VAT, and this is essentially a schematic representation of all of the different types of function calls that update the accounting balances in the system. Then there are sort of other side contracts like burning and minting Maker, the DAI savings rate, and so on. All of these events and all of these function calls come with a transaction hash and a token value. And what we're doing at Steakhouse is basically taking this technical conception and translating it into something that's commonly understandable from a financial point of view. So in this example, Maker is not a bank, but it can be usefully characterized to kind of look like a bank, because this is helpful for people who understand how banks function. And it's useful for people to understand at a glance what the state of the risk in the system is, for example, or what the benefits and risks there are to using DAI. There's utility to this framing because many people understand what assets, liability, and equity mean. As an example, you take, leverage collateral, issue DAI. You can issue assets on one side, liabilities on the other, and record the transaction hash. And if you do this for every type of function call, you eventually build up a ledger history for the MakerDAO system. This conception lets you also make interesting maps of the relationships between protocols or between companies. This diagram, which was drawn by my Steakhouse colleague, Seb Ventures, is essentially a map of the crypto banking system with interrelations between the balance sheets of, for example, a DEX like Uniswap or MakerDAO, a crypto bank. Looking at the world through this lens, you can understand the potential power of bringing together all of these value exchanges that in a traditional context, like this map is inspired by one drawn by Zoltan Pocher, legendary research analyst who used to work for Credit Suisse when Credit Suisse was still a thing. And the problem with the TradFi map is that all of the different value exchanges take place in different places, and they take ages, and they're inefficient, and they're manual. And on Ethereum, you can essentially redraw that entire map on the same place and sort of abstract away all of that rent extraction and intermediation. I think I have this upside down. To show you how we do this, we're showing you a small clip from a June analytics query. So at Steakhouse, we rely heavily on June. We think it's a very, very important part of our work because it lets us, first of all, not have to bother with any of the data stuff, which we're not experts at. And secondly, all of the queries are open. So it means the working is out there. So if people want to, look at the queries, criticize them, torch them, fork them, it's all available. In this example, we're coding a DAI savings rate transaction. So in the MakerDAO system, if you have DAI, you can put it in a contract called the pot, and your DAI will accumulate a savings rate of sorts that compounds every second. The transaction is basically an expense that reduces the equity and increase in DAI that increases the liabilities. So the balance sheet is perfectly balanced the whole time. And each one of these transactions comes with its unique hash at every instant. The output of creating all of this is basically a very long list of individual transactions, each with their little hashes, each with their little token values. And what we're showing you here, and this dashboard is available on the reference links if you go to our website, or if you go to the Maker forums, you can consult this Power BI view. This is basically a balance sheet. You have assets, liabilities, and equity. You have a sum across time that shows you the state of the MakerDAO system from a sort of financial institution's point of view. And you can do the same for the income statement. And the interesting thing is that for crypto protocols, the decentralized ones anyway, they don't really have a home jurisdiction. So the concept of a home currency or reporting currency is a little bit meaningless and abstract. So we take the view that, for example, a protocol like MakerDAO or Lido that has its own liability token, like staked ETH or DAI, that's the sort of natural token to report earnings in and report, the financial statements. But in theory, there's nothing stopping you from just translating everything to ETH or Dogecoin or Bitcoin or whatever you're most comfortable with, because it doesn't really matter. And so all of this data basically lets us organize the information for MakerDAO in a really useful way. And you can do things like Power BI views, you can do June dashboards, and you can even do A4 sheets of paper for boomers who like to print out this stuff and write on it for whatever reason. And the reason that triple entry accounting is the gold standard for financial reporting and transparency is, in my view, becoming more and more obvious every day. So like Enron had hundreds of millions of dollars in off-balance sheet transactions that in a sort of crypto context would have been instantly visible. If you took a look at Credit Suisse's tier 1 capital ratios a few days before they exploded, you would have thought everything was fine because they had a tier 1 capital ratio of 14%, which is perfectly reasonable. It's quite conservative, actually. But how on earth do you verify this? When Credit Suisse shows you this piece of paper, like there's nothing that you can do to check or to become comfortable with the fact that they're reporting the economic reality. However, with our numbers, with the MakerDAO numbers, if you don't believe them, if you don't trust us, and you shouldn't, you can open our query, you can check the work, you can download the list, and if you don't trust whatever, Infura or Etherscan or whatever, you can spin up your own Ethereum client and decode the contracts yourself and try to match the numbers. And I think that this independent verification is really groundbreaking. We work for a number of DAOs. So we have this work completed for MakerDAO. We have this work completed for ENS, which was a really interesting one. And we're in the process of refining it for Lido, which is a kind of stablecoin, but for the future. That's maybe for another talk. And we're careful to only ever release, findings and queries that we're comfortable with. However, so as protocols evolve, so does the financial reporting. So there's never a moment when you can say that the financial statements are sort of finished. It's always a work in motion, and it's always a process of iterative, communication with the community, with people on Twitter, with, investors. So in my view, I think we should aim to hit a steady state where DAO contributors such as ourselves are not talking necessarily about specific numbers, but we're talking about methods or choices about presentation. So like, why did you put, DAI savings rate expenses here rather than here? To close out, I think triple entry, crypto accounting is basically how DeFi will win. The least stable part of the global financial system are the humans at the center of it. And I think that this is the reason that why DeFi will win. And tools such as triple entry crypto accounting are how we're going to bring it to life. And just to avoid accusations of plagiarism, this is from Amin Soleimani, the creator of Rai, who's obsessed with this idea of getting rid of the humans in finance, which is probably the right thing. So, yeah, there's 5 minutes left on the clock. I'm really happy that everyone came in after lunch to listen to accounting stuff. Yeah, thanks for your time.